Hey there, this is Jeff Reeves. I'm the editor of InvestorPlace.com. I'm here with my buddy Charles Sizemore. We're going to talk about GDP growth, or I guess the lack thereof, in Q1. Charles, I'm going to read through some of the details right here. The GDP for America fell at a 1% annual rate in Q1. Some of the details show, that non-residential construction was down a lot, down 7.5% versus a 0.2% gain expected. Inventories weren't built up like some people had hoped for, especially after last year. So what's the score here? Should we read too much into a GDP decline? The market seems like it's not all that affected. If I'm an investor, what do I do with the GDP numbers?
Well, it was certainly an ugly number. We had basically a flat estimate at the beginning that's been revised down to a 1% shrinkage. That's actually pretty huge. But why did the market not really react? The biggest reason is that the market is forward-looking. If the stock market is a forward indicator, GDP is a lagging indicator. GDP, this data is from the first quarter. I mean, we're most of the way through the second quarter by now. This is from the first quarter. And if you do recall, we had a pretty rough first quarter in the market. January was one of the worst Januaries in years, decades really. And a lot of that was really anticipating what we're seeing here. So, bottom line, I wouldn't read too deeply into the GDP numbers. Yeah, they're bad. I would pay a lot more attention to indicators that are more forward-looking. I would look at the market itself. Looking at GDP for guidance in the market is sort of letting the tail wag the dog. Put it like that.
Yeah. And it's important to note, too, that all the data that we've seen since 2009 and this quote-unquote recovery that we've seen, the market has gone like gangbusters. It's doubled since the 2009 lows, but most of the GDP numbers show like a roughly 2% rate of growth annualized across the last 5 years. So, while it's not good to see a 1% decline, I mean, let's not make believe that we're ever going to see 4 or 5% growth anytime soon. So, if we're going to divorce kind of the whole GDP from the stock market thing, which I think is logical, then tell me, as an investor, what should I be paying attention to? If I'm looking for an opportunity out there, are there any kind of big picture numbers that I'm going to get guidance from, or is it more complicated than that?
Well, sure. Let's get more basic here, though. Let's go back in time a little bit. So over the very long term, you would expect stock markets returns to basically be proportionate to earnings growth. You would expect earnings growth to roughly be proportionate to GDP growth. Where all of that gets a little bit murky is that assumes valuations are constant. When you start at a very low valuation, like we did in 2009, stocks were at generational lows we will probably never see again. You could have just middling GDP growth and still have a raging stock market because you were starting at valuations that were just that low. Now valuations are high. They're not quite the bubble levels. I myself have thrown out numbers saying that based on cyclically adjusted price earnings, the CAPE, cyclically adjusted price earnings ratios, stocks are near the upper end of their historical range. Yada yada yada. That's all great. In a low interest rate environment, stocks actually should be on the higher end of the range, but they are by no means cheap right now. I would say best case they're fairly valued. Worst case they're slightly overvalued. That is not a recipe for gangbuster returns going forward. From this point on, you should expect stock returns to be a little flattish. That's just the reality. GDP growth will not. You're right. GDP growth is not going to go back to 3-4% anytime soon. I think for the remainder of this decade, real GDP growth, GDP minus inflation, I would expect that to be in the 1 to 2% range. That's okay. We've certainly lived through worse, but that is not a recipe for big blockbuster stock gains. That's a recipe for sideways range-bound action.
Yeah, and that's very important too. It's not a recipe for disaster either. I mean, like, we live in this binary world where GDP is either supposed to mean a raging bull market or that a crash is imminent. But as you talked about with some of the valuation expansion that we've seen, multiple expansion is the hallmark of a bull market. We came from a bottom. We're slightly above the historical range, but we're not like an outlier on the far side of the bell curve here. It's just
it's not 1999 again.
Right, and besides, as the old cliche goes, it is a market of stocks. There are bargains out there if you know where to look, and there are sectors that show strength. There are areas of the market where you can find opportunities. So I guess it's a platitude, but it is kind of a stock picker's market right now, right?
Yeah, I hate, like you, I hate to talk in cliches, but it is. But it's not just a stock picker's market. It's also I don't know, a global market. While U.S. stocks are, getting expensive, they're at the upper end of the range. They're not in bubble territory again, but they're getting expensive. European stocks are dirt cheap, and part of that is when we came out of our crisis in 2009, Europe was just getting started. They had their crisis every bit as bad as we did in 2008, 2009. Then they had another leg down in 2010, that sovereign debt crisis. So they're just now picking up the pieces and getting back on their feet here. Valuations there, as a result, are still very cheap. In emerging markets, valuations are generational lows. So there's still a lot of value to be had globally. U.S. just not so much.
Well, I guess not an easy answer then. So don't read too much into the GDP. Don't read too much into the big picture. I guess the lesson for investors is the same it always has been. You got to do your research, make sure you know what you're buying, make sure that the individual stocks that you own have decent fundamentals. It's not easy, right? It's not supposed to be easy to be an investor, right?
Hey, if it were easy, it wouldn't be fun.
Yeah, that's true. Well, it's fun for you. It's not fun for people like me who chronically underperform. But that's a different story. Anyway, thanks, Charles, and maybe next time we'll get some actual stock picks from you, some bargains that you see out there at home and abroad.
You bet.